Hello, everyone. I'm Jordan Jewell with VTEX. I'm a former analyst with IDC. I was the lead commerce analyst there for 7 years. I'm now the analyst in residence at VTEX, trying to take that approach that I had as an analyst to a software company. And in this session, we wanted to really think about what retailers should focus on this year now that we've entered the era of profitability. So I'm joined by our CEO and co-founder, Mariano Gomes de Faria, and Sam James with Carrefour, the largest retailer in Brazil and 8th largest retailer in the world, one of our customers. And to just, like, 3 main points, if you forget everything else, 3 main points are: 1, we have entered the era of profitability. 2, there are 3 main bets. I wrote a paper that I'll talk about, but there's 3 main bets to focus on for retailers and brands this year, and those are doubling down on existing customers, make fulfillment and inventory your strength, and engage with customers in new ways. So it's kind of cheating a bit, but that's the second point. And the third is that every retailer needs to think about profitability when making technology and really any investment right now. So quickly, this is the agenda we're looking at. We'll talk about the data behind the fact that we've entered the era of profitability, some of the brutal facts that every retailer is facing right now. We'll go through the paper, the 3 investments, and then Mariano will talk about some of the math behind the decisions that companies need to make, and then some closing recommendations. So this is all retail in the US. This is from the census, and it was just updated a month or so ago. And I think we've all seen something similar to this. We've all heard about the impacts of COVID, but what you'll see is growth was pretty steady in retail historically. You'd expect somewhere between 1 or 2%, maybe 5% in a really good year. Obviously, during 2020, you saw all demand stop for a little while, but then completely explode. So I took this growth rate that we saw and divided it into 3 eras, 3 distinct eras that every retailer has been living through right now. The first is the era of the old normal. I'm not going to talk about the new normal. I'm not going to use that phrase, but the old normal, because it was very predictable. Growth was predictable. You're balancing growth and profitability. Investments were kind of viewed as, okay, I'll make 1 or 2 really important investments, but it was kind of pretty standard. Like I said, from the latter half of 2020 onwards and all through 2021, growth was just insane. Both in e-commerce. E-commerce was extremely fast growth, in excess of 30%, but all retail grew a lot. Brick and mortar retail grew a lot. Demand was really high. It was because of money being pumped into the economy, all this pent-up demand, people weren't traveling. So all retail grew, and you saw a focus on growth and growth at all costs. But last year, in the first half of last year, we entered this 3rd era, where we are now, which is the era of profitability. And you're still interested in growth, but only if it's profitable growth. Every investment needs to be looked at under this lens, and I think the numbers are about 8 or 9% growth in 2022. Inflation's 8 or 9%. So the actual number of units a retailer is selling was pretty flat last year. So what does that mean for profits? So this presentation is under that guise of, we are in this era of profitability. Every decision you make as a retailer needs to be looked at in this lens. So, Sam, what have you seen at Carrefour when it comes to us having entered the era of profitability, margins being more important? What have you seen?
I think, first of all, I think looking through the lens of Carrefour, we're actually quite happy about having moved to an era of profitability. When I look at our core competitors in Brazil, they're all digitally native digital companies which are highly capitalized, right? And so when we were in the era of growth at all costs, it's quite hard for a company like Carrefour to compete because you have quite a lot of irrational spending on growth, which is something that isn't so achievable when you're a big public retailer, to lose lots of money on e-commerce on a long-term basis, right? So I think for us it's positive because it's put us on a more level playing field with the rest of our competitors. Having said that, the last 12 months we've really focused on looking at the fundamentals of our business and getting the unit economics right. To me, that's the key point, because if your unit economics aren't right, the more you scale, the worse the situation gets, right? And when we talk about profitable growth, we want to be investing in channels that are going to bring positive unit economics, are going to contribute to paying down those fixed costs, and bring a profitable business overall. So we've doubled our business in the last 12 months, but we also swung from a few percentage points negative in terms of EBITDA to positive. So over the last 12 months, we've managed to build a profitable e-commerce business while still growing. And that is really around focusing on the things that are going to move the needle and taking away things like crazy discounts just to bring GMV to hit your target for that month, whatever. We really want to focus on bringing valuable customers, investing in the early life cycle to make sure that we're keeping our customers engaged with Carrefour. And so it's been a real success story, I think, for us.
I have a question for you on this, Sam. You arrived in the company 2 years ago, maybe.
1 year ago.
1 year ago. So it's not easy to come to a team that's already there and say, oh, I want profitability, and the guys will say, oh, then I need to kind of smooth our growth, and then say, no, double down on growth and become profitable. How was the change management with the team?
Look, I think the team really bought in. How do we get to the point where we can grow and increase profitability? It's data, right? We need to look at all the investments that we're making and understand which ones are returning money and which ones are just giving away stuff for free, right? And so we drastically reduced the amount of discounts that we were giving to customers. We also massively increased the amount of investment, co-investment that we were doing with CPGs. And so that funded a lot of our growth, still offering good offers to our customers without us necessarily having to invest that much. And so the team really bought in because, ultimately, the better the profitability and the healthier the business looks, the more we're able to reinvest back into it because you have buy-in from the wider business. It's not just the kind of trope that e-commerce just loses money, and you start to see incremental investments that are more aggressive because we're able to deliver results to the bottom line.
Awesome. So now, again, under this fact that we're in the era of profitability, retailers and brands are facing some really tough economic environments in some ways. There's some challenges that we're going to be facing. Mariano's going to go through 4 of them. I'll follow up with the last one. So, Mariano, do you want to start off?
So 5 brutal facts in this topic. The first one is retailers are used to cheap money. Look that from 2020, we're living in interest rates of 0.5, 1, let's say average 1.5. And then suddenly in 2022, we saw that curve coming to something, wow, my God, it's 4%. Let's take a pause and see in perspective. I would ask for the next slide that to say that's not true that this is going to be a wow moment. Actually, it's pretty understandable that these rates can be there with us for many, many years. So this is the last block. It is what we are living today. But if you see in perspective, this is from 1970s. It's kind of likely that we are not yet at the end of the crisis. So don't expect the interest rates to come back. Don't plan for it. Plan for a tough sea ahead of you. I foresee that the next 2-5 years, that's going to be really tough. I'm going to go for brutal fact 2, and then I ask Sam. Brutal fact 2, 2008, 20% of was the number of debt comparing to market cap on the US retailers. Now this number is over 70%. So the capability of the US retailers to leverage the market cap to increase inventories or to do investment is over. There's no coming back from that. Look at the trend of the line. It's not even rounded yet. So it's a tough environment to come ahead. The companies, banks will not support that level of debt. So tough times ahead. From Carrefour, Sam, you need to navigate growth. When they say we double the business, literally, they are a public company. So they literally double, more than 100% GMV year over year. So that's say, wow. To have in consideration Mercado Libre, Americanas, all the other ones, they are doing like a 10, 20, minus 10, and they did 100. Followed by Group Casino, Éxito, that did, I think, 50 or 60. So how those guys are increasing inventory, increasing growth without getting more money from the market or from the stakeholders. How did you make it?
So I think, we have, when I look at interest rates from the consumer side, we have a big advantage in that we have our own bank. And so the combination of the consumer data that we have from what their consumer behavior is in our stores and the financial information gives us an edge versus on giving credit versus other kind of traditional banks. And so when I look at our kind of consumer electronic business as another, we've been able to kind of maintain credit levels above what our competitors have been able to do because of the strength of the bank.
If you didn't have the bank or if you were not a marketplace, you think the history would be different?
I think it would be a lot more challenging, particularly around consumer electronics. I think the other point you touched upon there, which is really interesting around growth without increasing inventories, is our marketplace business. So that was one of the shining lights for us in 2022. A business that actually more than doubled over that time. On Black Friday, for most of the day, it was actually selling more than the whole physical store network.
How many physical stores? It's big thing. Thousands physical stores. So it's not a.
Yeah, with like 50 employees. So yeah, it's a highly scalable business that we want to continue growing. But I think looking to this year, it does bring some challenges. Our debt situation is more challenging because we just completed a big transaction. We bought Walmart's operations in Brazil, so our debt levels are a bit more elevated, and obviously with higher interest rates, that's going to eat into what we're able to reinvest back into e-commerce amongst other things. So.
The ones that do the homework and clean the org chart, firing people, make them on a more high efficient mode, will be the ones that be able to leverage this in the market and buy others.
Exactly.
So it is a era of consolidation. It's coming in the next year. So let's see the brutal fact 3. Brutal fact 3 that retailers' valuations are suffering. So on the blue columns, the valuations of retailers. Retailers online, retailers distributors, retailers with special lines, retailers automotive. So all the lines on retailers are under the market. So you will not expect these lines to come back because of the profitability will not come back as easy, and the growth will be a line that will not move as used to be. So you will not leverage the valuation as a leverage to fund your as all retailers used to do in the last 5 years, equity funding, R&D, equity funding growth, not anymore. Now we are in a very, very high valuations, and this is US numbers, not a Latin American number. So take in consideration the brutal fact number 3. Let's jump in the brutal fact number 4, and that's for me the most red line here. You see, in 2016, retail sales was under $400 billion. We took Amazon out of this because Amazon is a marketplace. So those data comes from the US Census Bureau. And the inventory that you need to sell 400 billion, it was 600 billion. 50% more of what you sell, you need to have it. And see this as a kind of a solid trend. Nothing changed that line. Of course, a COVID, a war, and a recession changed that line. But how it changed it? Actually minimized the supply chain, but actually the return of the demand was an explosive demand by all the money that was printed. That happened in January 21, we almost have a big problem of supply chain. That problem of supply chain bumps the inflation in the world. And now the retailers are putting back the inventory. In the level that we are right now, 600 billion. If you have the historical kind of delta, we would need a 900 billion. The blue line needs to be overshot to be in the right level. That means the US retailers will need $150 billion on funding to get in a sustainable level of operation. But 3 years ago, they were funded in a 0.75%. Now they are funded on a 7%. They will not survive to that cost of carry. That cost of carry will take 1 to 1.5% of the bottom of the profit of any retailer on earth in the next 4 to 5 years. In Carrefour, Sam, it is a fact that you work well with the inventory management, you as a CDO of the company, it is a point of attention for you. What did you make in the last 1 year that changed the route of the company?
So I think it's not something that we've touched in the last 12 months, but it's something that's heavily on my radar for this year. I think when I look at our inventory management processes today, I think there's certainly a lot of opportunity to leverage data better to be able to reduce the amount of inventory that we have and also the amount of kind of breakage that you get because it's still done in quite an analog way. And so I do think that, you know, maybe some of that delta in inventory that you showed in the graph, we can probably take away by being more efficient in the way that we manage our inventory and potentially also reducing the number of SKUs that we're stocking to bring more simplicity to the business, I think.
And today you count on the warehouse and you count on the store's inventory as well.
Yeah, so all of our food is shipped from stores.
From stores?
Which, if you think that we had more than doubled our food business last year, that's a huge disruption for inventory management when we talk about the stores, because the processes for the stores are set up for people going to the stores and consuming, and suddenly a huge chunk of inventory is getting eaten up by e-commerce. And so that's been a major challenge for us, is how to manage this kind of new reality where e-commerce is growing very fast and changing completely the kind of inventory levels required in each store.
Something that they did was a very bold move to roll out to all the stores. There is a kind of a really omni-channel operation. And a CEO last week called me that they were rolling out a omni-channel operation and they put one store to be tested. And he said to me, Mariano, I'm happy because I'm gonna lab with one store, learn, and then I roll out. And I say, okay, let me convince you otherwise. Imagine you have a son or a daughter. You're gonna learn how to make them really like in the standards, and then you choose to have a second child. Just doesn't happen like that. You need to take the risk and say, it is a mandatory basis to put all your stores in your grid of inventory. Because if you don't have inventory or excess of SKUs, you cannot sell more. That's a basic kind of fundamental. So,
Just to add to that, I think inventory is important, but also when you look at kind of omni-channel operations, the time to the consumer is much lower, right? In theory, I can put an iPhone in the hand of 50% of Brazil in half an hour,
Yeah.
right? Mercado Libre cannot do that and will never be able to do that. And so if legacy retailers want to be able to compete with pure digital players, the store network is a really fundamental piece of that puzzle.
perfect. Brutal fact 5, Jordan.
I'm going to add actually to this chart. I forgot to switch it earlier, and so this is the difference. This is the difference between the inventory levels and the sales. So you can kind of see what we've experienced was what's called the bullwhip effect, where supply chain issues, demand went completely crazy, then retailers' orders came in late, and they, in many cases, if you look at the earnings releases of companies like Nike and Adidas and other companies, they had the wrong inventory. And there was heavy discounting. So what we've seen is this inventory levels going back and forth as a result of this, what I've been calling inventory chaos. So just to add more context. And then the final fact, just to kind of put a bow on all of this, is profitability remains elusive. Our partner, Publicis Sapient, did a survey where they found that 37% of retailers said e-commerce is not meeting their profitability targets. I was doing a roundtable a couple months ago, and I was talking to a company that is a brand, and they were launching direct-to-consumer, and I just flat out asked the question, is your business profitable? And the guy just didn't know the answer to the question. And I think that's especially common in D2C, but that's just a common problem. And now that we've entered the era of profitability, all eyes are on profitability. Just because you're growing doesn't mean a lot if you're not profitable. We've been talking a lot in this section, Sam, so I don't know if you have anything to add from a...
I think, good.
So part of the research that was going on here with all these charts and all this data is, as a former analyst, I love to do research, to write reports, and tried to really boil down and answer the question, if I was a retailer or brand and I had to focus on 3 things, that's it, in 2023, what would they be? So we're releasing this paper today. It's a longer paper. It's 20-something pages. We're going to give you the Cliff Notes version. I highly encourage you to download it. Email me and I'll send it to you. But I'm going to now go into practically how do you apply these 3 bets, these 3 investments to drive growth profitably. So one is doubling down on existing customers. So this is not rocket science in my mind, but about 80% of marketing budgets from an average retailer is spent towards new customer acquisition. The problem is that new customers actually lose money, and they actually lose more money than they did 10 years ago. This evaluation was done by Simplicity DX. They did an analysis of looking at numbers 9 or 10 years ago and now, and they actually found that new customers are more expensive than before, whereas repeat customers who bought from you before, who come back, are more profitable. And there's various reasons for why that is, but I think it sounds extremely simple, like duh, everyone knows to focus on existing customers, but no one does it. Everyone's focused on buying ads on Facebook or Instagram. Everyone's focusing on acquiring new ones, and it's just a reminder to focus on some of these things. We looked at some of our customer base and did an analysis of plotting out how many organic orders does a customer place online, and what's the average order value. And in the paper, there's a methodology you can follow to do this yourself, but essentially, the idea is that you set up a quadrant for your own business and plot your customers in these 4 quadrants. And what you find is those brand champions are driving a huge portion of your business. Those are the customers you really want to focus on. And second, you want to move some of those impulse buyers or discount shoppers who are not quite meeting the mark in other categories. You want to do everything in your power to move them up to the top right. So I'm going to give you 3 actions, 3 recommendations to follow for doubling down on existing customers. So first is to seek loyalty over acquisition. I've already talked a lot about this. Collect first-party data. So along with focusing on those existing customers, you probably heard this a million times by now, but you want to know who your customers are. And one way to think about this is doing different engagement models to actually collect that data, whether it be SMS for messaging, live shopping directly with your customer, to actually collect data in different ways than historically were done. And third, to be channel agnostic, meaning the customer is the channel in the future. There's actually a quote that said that by an analyst at IDC that's in the paper, but the customer is the channel going forward. It's omni-channel is different than it was before. So, Sam, what would you say are some of the investments you've made in doubling down on existing customers at Carrefour?
I think before even talking about investments, I think what the biggest change that we made was really changing the way we think about the mechanics of the e-commerce business, right? If you think about thinking about traditional way of looking at e-commerce, I generate a certain amount of traffic, I'm going to have a conversion rate of X, and then I'm going to have an average ticket of Y, and then that kind of sum is my GMV, right? But then that's exactly takes you down the road of I don't really value the repeat customer at all. I just value the traffic and the conversion. So how do we think about our e-commerce business at Carrefour? The sum adds up the same way, but it's number of clients, right? And within that, you have new clients and churned clients, right? And the net of those 2 numbers, plus your existing customers, is what's going to give you a number of clients. And then that number times frequency of purchase. And so I want to drive higher and higher frequencies of purchase from my customers. And then last is obviously average ticket. And so when you start to rethink of the business that way, the things that your product teams, your business teams are going to focus on are completely different, right? Because instead of thinking about, how can I eke out a little bit more conversion, I'm thinking about how can I reduce my customer churn? How can I increase the number of frequency of purchases? And by definition, all of those things are focusing on existing customers, right? And so we completely, the concept of how we think about the business changed.
This is I call these a ownership mentality versus a org chart mentality. You know, when you have a big VP of marketing, acquisition, it brings headcounts and bring budgets, and that's the cocaine of the retail, right? So it is easy to fall for that, but don't be addictive to that. That era is over. So change the power of the org chart by taking the power of the marketing organization and bring the power to the customer service organization. Then you're gonna have the results on discovering new channels for the same clients. And just to be very precise, the client that buy 2 orders, but the 2 orders comes from Google Ads, they are not recurring customers. They are 2 new customers. You pay 25% for them. So how you will avoid Google should be a science in your company.
Yeah, and I think when I think about investments, we look at the way we've kind of tooled our CRM to be much more focused around return on investment. And again, that brings you back into focusing on existing customers, because when you are investing on a loyal customer and trying to build incremental purchases with them, the incrementality of that and the profitability of that is generally much higher than kind of scattergunning discounts everywhere, right? And so the ROI then is deeply focused on creating loyal customers and maintaining them.
Perfect.
Perfect. So the second action that we talk about in the paper is make inventory and fulfillment your strength. The very high level idea here is that at most retailers that I've spoken to as an analyst, fulfillment, order management, shipping, all of that, returns, they're viewed as a cost. They're kind of an afterthought. You get the purchase placed, they're kind of an afterthought. And let's flip that. Let's make inventory and fulfillment your strength, something you focus on. So it talks more about this in the paper, but as a former analyst, I developed a maturity model to actually map out what the different maturity levels of omnichannel are for order management, fulfillment, and inventory. And what we found is more than half of the retailers that I've spoken to and surveyed are not even past stage 2. This happens quite a bit in maturity models, but what it means is companies have made some level of investment to get their fulfillment up and running. They're moved beyond stage 1, but they've stalled out. There's a chasm between stage 2 and stage 3, and that's really difficult to cross. So for many companies, that's what they need to do. They need to cross that chasm to stage 3 of omnichannel maturity. And the recommendations to help companies move along that are, 1, treat fulfillment like a product. So I mentioned that I was talking about this in the beginning, but what if I think about fulfillment and my different fulfillment options about how fast something gets to a customer, how it's shipped, returns, anything like that? What if I thought about it with just as much importance as my actual product? Customers are buying from me with fulfillment at that same level as the product itself. That's why people buy from Amazon largely. I think every retailer should put it at that level based on the research. Second, unifying inventory. I think this is pretty obvious, but you speak to the vast majority of retailers and brands, and inventory is a mess. Every time I've gone to buy furniture, it's been a mess. They tell you something's going to come in 2 months, and it comes in 1, which in my mind is just as big a problem as something coming late. So this is something to focus on. And then finally, harnessing marketplaces. So Sam talked a little bit about how they're using marketplaces at Carrefour. A lot of our customers at VTEX do that. But what we've seen is the most mature companies who've gotten to stage 4 or beyond have leveraged marketplaces or run their own marketplace to achieve that. So Sam, how has Carrefour moved along that maturity curve?
So, the biggest thing that we did in the last 12 months really was scaling our click and collect operation, right? So, if I look at 2021, GMV on click and collect was basically 0. We closed December with something like 30 to 40% of our orders coming from click and collect. And so this is the best of all worlds, right? Because it's an option that clients are choosing actively and liking. And obviously the logistic cost for Carrefour is much, much lower if the customers are coming to my stores to collect. And added bonus, a significant chunk of those customers then enter the store and then buy something else as well. And so and if I could put a third bonus on top of that, we are able to have a touch point with the customer when we talk about consumer electronics. That allows us to buy, to sell extended guarantees, insurance, other things. So it's completely changed the profitability of the business model, being able to use the store as a hub to kind of fulfill e-commerce orders. And so
was tough to convince the VP of physical stores to embrace this idea?
I think it's all around aligning incentives, right? And so the store, all the e-commerce sales that come out of the store go onto the P&L of the store manager. And so he's super happy because he's got like a big incremental revenue.
Pretty obvious,
Yeah.
but it's very hard to implement the obvious sometimes in big organizations.
But then we still have some issues with perverse incentives. So our online prices are not the same as our store prices. And so when you have a click and collect customer who's buying a TV at a lower margin, for example, than he would have bought it in the store, that puts pressure on the margin overall for the store manager. And so we still have to manage that process a little bit. But overall, I think it's key that you align incentives with the business. Otherwise, the business is going to fight back against you always.
Yeah. And it's simple. Pay for where you want to go, right? It's to align the bonus of the first layer of your executives is pretty obvious. but I don't see organizations moving to that direction. I'm glad that Carrefour figured out like that and say, done, or we do it. And
Well, we figured it out through the pain, right? It was not that we brilliantly thought of it beforehand. We saw that it was an issue.
suffer a little bit.
And we managed to.
That's how
kind of
life is,
adapt,
right? You
yeah.
need to suffer a little bit, then you
Exactly.
do the bold decisions. Okay.
And the final investment or action that we found writing this paper was engage with customers in new ways. So the summary here is that you look at the vast majority of sites online and how you engage with a brand or retailer look pretty much the same. Some look nicer than others. They use video more. Some like have cooler colors, whatever. How you buy something is basically the same on all of them. And in my mind, everyone's modeling after Amazon. Amazon kind of decided where the picture is, where the description is, where the comments are, and everyone copied them. And there's not that much differentiation. That's what the quote from Mike here says. There's a homogenization of experiences online. And we're not talking so much what it looks like, but what we found is that some of the savvy or forward-thinking brands and retailers we spoke to are trying to engage with their customers in a different way. I tried to put this in plain English, like just try it in a different way. So the 6 models that we found were shown here. I'll very, very quickly go through all of them, but live shopping, holding live events with your customers. You can then retool some of those videos to put on your product pages and elsewhere. Overall, video drives engagement a lot for brands and retailers. Second is conversational commerce. So one of our customers, or multiple of our customers are using conversational commerce so a customer can actually buy something with WhatsApp, for instance, or Messenger, or another app. Personal shoppers, so like live shopping, but with a one-to-one engagement between a sales associate and a customer who can walk a customer through the purchase process. Similar to how it would work in a store. Next, virtual store walkthroughs. So one of our customers, Farm Rio, did this, and it's actually really cool. They got a Matterport, basically, and stuck it throughout their store, filmed it, and you can walk through the store. You can go on their site and walk through the store. And what's cool is with VTEX, you can actually say, that clothing item looks awesome, and you can buy it directly from that site. And it's not just the fact that you can buy it from there, but the level of engagement and conversion rate for those customers who do the virtual store walkthrough was much higher. Meaning those are customers who want to engage with you on a higher level. So if you give them the ability to do that, you can raise their conversion rate. Next is immersive PDPs, product detail pages. The summary for that is just using more video. Put video above the fold. Many of your customers are not going to go below the fold. Stick the most engaging content right above the fold. And then finally, conditional content. It's pretty small on the screen, but one of our customers, Eric's Bikes, I think it's pretty cool. They sell bikes and sporting goods, but if you're buying a bike, you can go on their site and actually select, I am a novice. I don't know anything about bikes. I want it for on the trail. I want it to be this price range. And they actually curate the catalog for you based on how you answered those questions. So there's many different variations of that. You can also tailor, for Carrefour as an example, let's say you have a gluten allergy. You could tailor the catalog based on that or something else.
And just complementing Jordan, what's a personal shopper? Imagine it as a concierge commerce. For example, there is one process for the digital grocery commerce that it is the picking, right? Picking in store. Why that service, it is only available for digital? Imagine yourselves here entering a Carrefour physically and somebody offer you and say, give me $5, stay here, ask a coffee. In 30 minutes, I will be back with an entire list done and you just go check out. I would pay for it. It's my moment in Instagram and TikTok and I hate go to the aisles and pick the things. Why those service is only available for the online? So what I predict it is the concierge commerce will penetrate call centers, physical stores, any kind of experience will have a touch of this service behind. So you, Sam, on Carrefour, you are seeing new ways of engaging the same client. Did you already try something? Are you gonna will to try?
So our big bet, and we're working on this currently, hopefully have some kind of big news to share in the next couple of months, is around the conversational commerce side of things. I think, in Brazil, WhatsApp for a lot of people is actually the internet. So I think 55% of Brazilians have purchased something online. 85% of Brazilians have purchased something via WhatsApp. And so having that as an option for our clients opens up a massive amount of new potential customers, obviously. It's already something that happens if you go to, ironically, smaller, more kind of unprofessional retailers in the kind of interior of Brazil already operate this model. They already work on WhatsApp. They already have a big amount of their revenue coming from WhatsApp commerce, right? And so in that sense, Carrefour, we need to catch up and build, I think, potentially a very powerful sales channel for us. I think that it's going to be very, very big.
Awesome. So the 3 recommendations here, and I know you've all been taking pictures, so I'll just put it up for you. The recommendations are, we've already talked about this, but lead with video. Make video a key focus area for your business when it comes to product pages, your entire site, etc. Second, prioritize product pages. Most of the customers I interviewed for this paper said, oh, we'd really love to focus on our product pages and improve them, but we just haven't gotten to it yet. And what you'll find is, it obviously depends on your industry and how customers hear about you, but for many customers, they don't even see your homepage. Like, your product page is your homepage if they get to you by Google. If they Google running shoe and they click on it and they get to your product page, and they leave, that's all they see. They have no experience with your homepage or about us or our story or whatever. All they see is that product page. So put more emphasis on the top 5 grossing PDPs on your site. And finally, an API-first approach, however you want to build your technology stack, an API-first approach enables you to more easily switch in and switch out some of these more new engagement models. So, and we've already essentially talked to you about this. So I want to, going into our next section, none of these are rocket science. Like, I've tried to put them in plain English. They're pretty straightforward. They're not entirely related to technology, because this is just what retailers said when I asked them, what are you investing in to drive profitable growth? And they're not rocket science, but they're under prioritized in my mind. And the point of the paper is to focus on those. And to go into the next section, what I would say is, when I was an industry analyst, I talked to a lot of software companies, technology companies, and they're all out there on the expo. They're going to tell you why their product is awesome and how it'll help you make your site faster and sell more and whatever. But at the end of the day, it doesn't matter how fast your site is, how cool it looks, whether your CDP is super sophisticated. If at the end of the day you're not selling more stuff or reducing your costs, it's just a math problem now that we're in the era of profitability. So Mariano now is going to go a little bit into the math.
Yeah, we are calling this session Do the Math and Take Action. It is you can ask for the best of breed of everything, but at the end of the day, you're going to pay for that. You're going to pay for, imagine like you want to allow imagine a 50 people team. Everybody wants to have their own opinion. So imagine that they have a completely freedom to choose. Each one of them will choose one system to call their own. But to work together in this headless nightmare, actually the composability of those 50 solutions also, it is a danger by itself. A security, privacy, SLA, and most of all cost. So when you get your users satisfied, you get your stakeholders unsatisfied. And you can reach a level of unsatisfaction that can go more than 3, 4, 5% of your GMV. So we are hitting here in the United States a lot of clients with data, warehouse, DWs, segmentation tools, like dozens of service, but they are paying 12%, 10% of the GMV for the stack of technology. That's just not sustainable. So we take an example here. The way a CTO looks at the numbers, it is not the way as the market look to the numbers. So the CTA allocation of, imagine that you have a team of 8 people to build something, or a bridge, or a middleware, or a app, whatever. 8 people, 1 QA, 1 infrastructure, 1 design, 1 BA, 3 developers, $2 million team. The CTO built these in the first year. In the second year, they learn what they made mistakes in the first year and revamp and do it all over again. In the third year, the team that build, because developers, they love to build, they hate to maintain, they leave the company, and then you hire new developers to take over the code that in the last 2 years was there. And what the new developers they do when they arrive and say, no, I don't trust other one's code, and I will revamp the code again. So the third year they spend the same amount of money, and then they go over and over, spending $2 million year over year for maintaining the same outcome. Great. The CFO doesn't look at it in the same way, because they have the leverage of allocation of CapEx. So in the first year, it's not a $2 million that put in the balance sheet. That gives me a 2.5% profit in my retail. But in the second year, that allocation comes in a 5 times or 8 years amortization. And you can see that for the CTO, $2 million a year. For the CFO, only in the 5th year, you reach in your balance sheet what you are really spending. To not call this fraud, I would call this a very create accountability. And this is a write-off that all retailers on earth needs to face it. You have in front of you 5 years of amortization of softwares that you are already being deprecated, and they are dead. And then you are faking your own profits. Not for the sake of your career, but for the sake of your stakeholders. You need to write off. You need to go for a predictable thing. If you don't do it, this amortization kind of waterfall will kill it. So do the math. Only decouple from a backbone software what really will increase sales or really reduce operational margin. So here's an example. In the left side, you have a platform that you can add things, decouple, and in the right side is a more headless approach where you allow the users to hire any software for anything. You end up paying 3-4% of your GMV to technology. Once the limit of the water, it is 1.5 max. So it's not a matter of freedom. It is a matter to choose what to decouple. And only decouple the things that brings you to sell 5-10% more, or to save 5-10% in your costs. I think Carrefour passed through this transformation. Carrefour were in the right side, big spends, big team, big everything, big at the end nothing. And they moved to a new platform, and now they can release new things without doing the math. So Sam, I know that you are 1 year in the company only, but you have been working with VTEX in the last 1 year. Is this resonate internally with the C-level of the company? Your experience with us is, do you feel that you have a predictability in your costs? What's this model for you?
Yeah, so I think how we're kind of constantly evolving how we're thinking about this topic, right? But I think the challenge that we had kind of on the right hand side, was a very messy technology stack, and also I think we lack the talent internally to be able to build something that was worthwhile, and we're competing against really sophisticated digital players with the best talent in the market, etc. And so, the strategy of the right-hand side of this graph was just not working because we didn't have the talent, the cost was high, etc. And so we were able, moving across the VTEX, to really, have a strong, solid foundation, a platform that is able to serve our needs, and that's allowed us to focus on scaling the business, right? I think, as we move forward, what we build versus what we buy, I think is going to be really around, what are the core things that are going to really make the difference for Carrefour that are not something that I can just take off the shelf, right? And,
we are moving from a building economy where you could exchange equity to R&D. That was okay, that was amazing. Investors wanted you to do that. Actually, there's no money anymore to do that. Actually didn't pay out the bill. So now we are moving to what we call the testing economy. CIOs, and I'm seeing here the CTO of Carrefour, Ney. When Ney arrived in Carrefour, he told me, I don't want to build absolutely nothing, but I want to test like a hell. That's the modern forward-thinking CIOs applying, where power is not in how we control CapEx or headcounts, but how many tests with different tools we are able to promote to the business, and then we choose what to do it. So we are seeing a era of these headless freedom almost ending, and a new era will come where we don't have a name yet, but it is more in this testing thing. So we have 2 slides to show what would be. For example, this is a end-to-end, what the market is calling a unified commerce platform stack. So you can have all from scratch natively from a platform. In this case, our own company, right? But you can put other names there. But then suddenly a marketing guy or marketing VP wants to test Builder.io or Algonomy or Akinio or whatever. How much would be the cost of that, and how much would be the increase of sales of that? And then if it is not good, then you can come back, turn off, say, oh, I tested this PIM 3-4 months, oh, didn't come as I imagined, and then I turn it off. And then you have your team always testing where the company wants to go, not by necessity, but because you desire. So this is what we call the decouple platform, and this is where VTEX stand our grounds. Say, do we have the best search in the world? No. Does the best search in the world increase more than 0.5% sales over VTEX intelligent search? No. So write off. Use the basics. So this is our main and last message. Only decouple what will be strategic business advantage with a clear sales and margin results. And we have time for one question.
I guess one thing for you, Sam, is how do you measure this? Especially from like the talent perspective, like that's really difficult. Like the trade-offs are, I think, like when I was an analyst, I tried to actually calculate the ROI of some of these decisions, and there's nothing out there. It's like impossible to get these numbers. The vendors were telling me they would love to get the numbers. No one had them. How do you make some of these decisions about which, like, do I want to go ahead with this solution or stay with what we currently have? How do you kind of rationalize that?
Yeah, so I think, particularly in a world where, there's limited resources, limited investment, the first lens you're looking at is, okay, what is my strategy? Where do I want to get to? and what are the things that are going to give me a differential versus other players. And I'm not even necessarily talking about solutions, but also conceptually, what are the areas that I need to focus on? So like one of the big things I've identified for Carrefour is frequency of purchases. How can I get customers, everyone eats every week. So why aren't my e-commerce customers buying on my e-commerce every week? So how do I build that frequency? And there may be like multiple different solutions. There may be stuff that we can build internally. But it goes back to exactly what Mariano said, is testing. We have invested quite heavily in building out a very sophisticated data team. And one of literally the first thing my chief data officer, when he walked through the door was, we need a really strong testing infrastructure, right? That is the very first thing I asked for him, because it's impossible to build out ROIs, understand that equation between build or buy or decouple solutions or whatever, if you implement something and then you have a really shitty way of measuring whether it worked or not, right? And then that's how you end up down this rabbit hole of putting a bunch of stuff and not really knowing. And I think there's also big challenges when you start down that road. You have like overlapping impacts, and so it's quite easy to get lost. And so I think for us, we're really starting down that journey. But right now, we're 100% VTEX basically, and so strategically between Ney, myself, and the guys back in Brazil, it's okay. What are the things that are really going to make the difference to our business? How can we change that? The rest of it, we don't really want to think about.
Yeah.
You guys have teams focused on, I don't know, checkout, whatever, who are specialized just in that. For us to build out that infrastructure internally, does it make sense? Probably not, right? And so,
It is simple, but it's powerful. And I am happy that you accept to be here, because you are saying like simple things here, but we are facing, we manage 3.2 thousand stores in the world, from Asia to US. You can imagine like how difficult it is for a CDO to convince a CIO, to convince the VP of physical stores, to convince the CMO to just do the basics. Mm-hmm. It's pretty tough. So we summarize here the last message. Now that we are in an era of profitability and retailers are facing major headwinds, you must simplify. Org charts, get rid of layers. Inventory, unify your inventory across all the market, not only yours, but where you have your product in the market, integrate it. Headcounts, simplify your headcounts. Less is more. Maintenance, you need to have a low maintenance. If you don't, you're gonna be in the mud where the money it is in 7% a year in dollars. So that's it. I would like to invite you all. Sam will be around in the conference. Ney here, the CTO of Carrefour, is also be around. It is an incredible case, growing more than 100% year over year, profitable business. So if you want to engage them, scan them. Also, please download the paper that we have put together, so you can scan it and you can download it. I invite you all to come to VTEX booth to talk to a solution engineering. VTEX is proudly putting the solution engineers in front of any client that wants to talk to VTEX. So that's our way to see the market. We want to help the clients to understand our product. And if you are a party guy or a party woman, we host the best party with the Una, PayPal, AWS, a lot of Valtech and Pivotree here. On Monday at 8, we host the best party of NRF. So it calls The Party. Anyone with this pink bracelet, it is already inside. So go to VTEX booth and find it. All the sponsors that I mentioned here has bracelets. So go over their booth as well and ask for the D-Party bracelets. Sam, Jordan, thank you very much. Thank you guys for coming.
Thanks, everyone.